As earnings season comes to a close, let's take a look back at all of our top stories and guests. We cover tech, retail, entertainment, and more. These conversations around trending news, giving viewers an inside look into the future of the market. Take a listen.
Intel bounced back in the second quarter with a return to profitability following two back-to-back quarters of losses. Revenue fell 15% year over year, but the chipmaker did give more upbeat guidance than expected for the current quarter. Intel CEO Pat Gelsinger joins me now. Pat, always great to get some time with you. In terms of the Intel turnaround, is it fair to say that the worst days that I think investors saw from the prior few quarters, is it over? Can you confidently say that?
Hey, thanks, Brian. Always a pleasure to be on Yahoo Finance and to chat with you. And yeah, we had a very solid Q2 and beating on the top line, beating on the bottom line, exceeding on both our PC business as well as a bit better than we expected in the data center business. So I just say we finished the quarter feeling really good, good response from investors as we rolled out the news. And I do think we've seen the worst. And obviously, the PC inventory levels are now healthy again. And we're seeing the demand signals. We think we still have a little bit of inventory on the networking and the data center to fight through in the third quarter of the year. But I really think the worst is behind us at this point, and our raise to the guide for Q3 really portends to a more optimistic future. So super proud of my team and making a really good quarter happen for us.
Pat, you told me 3 months ago that green shoots were starting to form, and it looks that way from the guidance. So is it okay to say that those shoots are now morphing into plants?
Yeah, they're getting a little bigger and a few more shoots as well. But I'll say, if we think about that, getting the client, the PC business, healthy, right? Good inventory levels. We're back to historic market share levels. So I'd say, that clearly has gone from a green shoot to a plant at this point. Data center, hey, we did a little bit better than we thought we would in Q2. The product roadmap, Sapphire Rapids, Gen 4, Gen 5 with Emerald Rapids, looking to PRQ in Q3 a bit ahead of schedule, and the roadmap for next year. So I'll say we're still sort of at the green shoots level there. We had a big uptick in our AI pipeline, particularly led by our Gaudi product line. 6x in the quarter, $1 billion plus pipeline. So I'll say that's still in the green shoot phase. So overall, good green shoots and good execution on our process technology. The all important, do I have the best transistors in the world? And starting to see some good momentum in the foundry business. So I'll say, we have at least one good solid plant and plenty of green shoots other areas in the business.
Fair enough. I could deal with that. So I want to talk about AI in a second. I have to make sure people watch this whole interview, Pat, so I'm going to save it to the end. Let me go back to the state of the PC market. What does the recovery look like in terms of PC demand, and how do you see it playing out for later this year?
Yeah, so we're expecting, nice quarter-on-quarter improvements in it. Part of that is by the inventory level adjustments that are now behind us. We're now to healthy inventories at OEMs and distributors. But our product line is good. We gained market share, again, we believe, and ushering in what we call the AI PC, with our next generation product. We call it Meteor Lake is the name for it. We have new capabilities in AI built into the product that are going to allow you just to do cool things in your PC, and being able to do real-time language translation, be able to do transcription in real time, video effects, all of these type of things, new gamer models. So we see that being like the Centrino moment for bringing Wi-Fi into the PC 2 decades ago. We see this AI PC as ushering in a new class of applications, major application upgrades and ISV excitements, and we're leading the way with our Meteor Lake product in the second half of this year. So healthy and great opportunity in the future.
Pat, why doesn't the street give you enough credit for what you are doing in AI? And I bring that up. You just told me you have $1 billion plus pipeline in AI-related products. What do you guys need to do at Intel to get that word out?
Well, I think there's two things going on, Brian. And, in this, I think we have yet some things to prove in the marketplace. But one is there's the accelerators right? That have now, become the way that people are executing their Gen AI training environments today. And so there's a surge of interest where everybody says, hey, I got to get my Gen AI models up and ready to go in my clouds or in my enterprises. And a lot of that's going to the accelerators. So does that become a depressor of Xeon demand, where we have a very big and healthy business? So that's one effect that people are trying to understand in the market. And then the second effect is more aligned with your question is, okay, Intel, are you going to participate in that accelerator market? And, I'll just say we haven't been as aggressive out of the chute as we should have been. And now with our Gaudi product line really starting to get interest in the marketplace, customer pipeline is building very rapidly. And we have a very robust roadmap. Gaudi 2 is shipping in volume today. Gaudi 3, I just received first silicon on it, so it's sort of like a 2x level of capability, and we'll be launching that for volume shipments next year. And then our 2025 product is already well underway. So 23, 24, 25, we're showing up. We're starting to make a impact in the marketplace, but we have to prove it because we have a clear market leader who's executing very well. And I also see that as a potential foundry opportunity, that we're actually going to become, a foundry supplier for some of those AI chips as well. So we see the potential to be a provider of those chips, those AI accelerators, but also a foundry for those chips at both the wafer and the packaging level.
A couple of your competitors, Pat, I think you may be referring to NVIDIA, maybe or maybe not, but a company like that, they just had almost a $4 billion reset higher in guidance. But I hear everything you're doing in AI now. I mean, do you think you will have a similar moment next year as these AI accelerators that you're making get into the market of people, and the street needs to reset its expectations for your company in terms of how much profit you can earn and how much revenue you can earn?
Well, I'll just say, NVIDIA's done a good job in this space, and they've really led the way. And as I like to say, they worked super hard, and they got lucky in really being at the right place at the right time for some of these algorithmic breakthroughs. And the AI space is still fairly young, so I think there's a lot of opportunity for us looking forward. We're starting to show up, winning customers and getting real enthusiasm because the market wants alternatives here. And so we're hearing our customers really say, okay, how can you show up to give us good alternatives that are more cost-effective, power efficient, capabilities that the competition doesn't offer? So I feel good about our roadmap. I do think that we will start to incrementally get more credit for that as we go into next year, but I have to execute that well. So I think in this regard, I think this is one of those green shoots that another quarter or two under our belt, I think we'll start getting credit from it from the market's perspective.
I know you're very much a globetrotting CEO. You're constantly on the road, visiting other countries, pounding the table for Intel's business. We just had a credit rating downgrade in the U.S. As a global CEO that has many connections overseas and who has been doing this for a while, I mean, what do you think this downgrade says about the state of this country, and what does it mean to a business like Intel?
Well, I'd say overall, is anything going to displace the U.S. dollar as the global currency for trade? And I just say, I don't see anything on the horizon, for that. So at one level, I just sort of say, okay, it's a downgrade. Hey, there may be some implications on cost of debt, but I really see that as somewhat minor. I view it more as a statement. Hey, get our debt situation under control in the U.S., and the credit agencies are starting to get a little bit more, concerned in that regard, right? But I'd say in terms of the impact of me running the, Intel as a business, or CEOs like myself running global businesses, I don't see that much real impact from this change. That said, hey, as the more stable global currencies are, the more they see the U.S., right, as that leader that everybody can bet on, as we get our own inflation situation under control, and the ability to now start being that leader of global trade again is something that we've put a lot of emphasis on. We want open global markets. We want to be able to sell our products globally. I think all of these tie together to say, this is what it takes to run a great business today. It's a globally interconnected market. We want balance and resilience in the supply chains, and we want access to global markets.
Shares of Starbucks this morning are a little changed after the coffee giant reported strong international sales boosted by China's recovery. Same-store sales did come up short of analyst expectations. Rachel Ruggieri is Starbucks CFO. She's joining us now alongside Yahoo Finance's Brooke DePalma. Rachel, always good to see you here.
Hi.
Hi.
Hi. Morning.
Good morning. You've had your coffee, clearly.
A lot of it.
So, Rachel, let's talk about, in particular, what you guys are seeing in the U.S. I want to start there and with the same-store sales growth in the U.S. and what you're seeing in terms of traffic trends versus price trends, how all of that fed through during the quarter.
Sure. We would start with the fact that we had a 7% comp. And of that comp, about a point came from transactions. And we're seeing growth across the board year over year in every single day part. And so that's a good indicator of the health of our business. In addition to that, our ticket was 6%, which is elevated. But I think what's important in our ticket is there's a balanced contribution both from strategic pricing, but also from increasing customization and record food attach. And that's important because that shows a volume or a unit component to our ticket. And so when we look at that, that's what's driving the record demand that we're seeing in the U.S. business, which led to our average weekly sales being a record this quarter. You take the combination of the transactions and the ticket with overall new store growth, and we're seeing our average weekly sales the highest we've seen in the history of our company. So it speaks to the demand we're seeing, as well as the record engagement across of our customer group. And we're really encouraged by those signs. I mean, there's a lot happening in the economy, but for us, our demand remains very strong, and we're encouraged by that. And we're continuing to fuel it with the innovation that we're making in terms of our offerings, as well as the increasing digital capability we have and the convenience channels that we're growing. We saw delivery grow this quarter from 4% of sales this quarter. It was just about 2% of sales about a year ago. So we're seeing demand continuing to increase, and we think it speaks to the strength of the brand, but also the loyalty of our customers.
And Rachel, a quick follow-up on that. Last quarter, you told us that you expect price increases to return to a more normalized level of 1% to 2%. Are you still expecting that?
Yes. Yes, in the fourth quarter, we'll have fully lapped the pricing moves that we made last year. And so we've benefited this year from the annualization of those pricing moves from last year. So we'll start to see our ticket normalize from a pricing perspective. But we still believe our ticket will be elevated because we have this ability to continue to drive customization, a mix to more premium beverages, as well as increased attached. Our reinvention plan goes directly at creating the capacity in our stores to be able to serve our customers' needs around customization and attach. And that'll show up in an elevated ticket. So we're encouraged by the demand that will continue to fuel both in our stores as well as digitally.
Rachel, I listened to your earnings call yesterday, and one of the things that stood out to me was modifiers,
Yes.
like the cold foam, et cetera, and how that accounts for around $1 billion in revenue annually. How much more can you all squeeze out of that before consumers say, Uncle?
Yeah, I think it really comes down to creating the capacity in our stores to serve that demand. Our reinvention plan is positioned to be able to create a more stable environment for our partners, and that's through wages and through better training, and that's helped to stabilize the environment, bring the turnover down, and stabilize the environment. In addition to that, we've made investments in equipment and in our processes, and that helps with overall throughput. And that throughput helps us to be able to support customers' desires to customize. We don't think that's going away, and we actually have a very deliberate way to innovate and further our customization over time. But it's important to make sure that we create the capacity so that we create a good experience for our partners in serving that with our customers. And our customers naturally customize. So the more we can innovate in that space, I think we have a lot of opportunity ahead. And when we talk about modifiers, that's the same as customization. And that leads to strength in our ticket and has a volume component which supports the demand that we're seeing.
Rachel, as we've talked about before, cold foam is a big modifier that is popular in these parts, in this office.
Yes.
I was also struck to see that 75% of the beverage sales are now cold beverages. And this wasn't even in the height of summer when it's super hot.
That's right.
Is this a secular change in how people consume coffee? Is this is this just what it is now, that people are going to drink cold coffee year round and that's it?
It's definitely skewed more towards a younger consumer. And so we have a large consumer base of millennials and Gen Z, and their taste and preferences tend to be more cold. Now, I'm way over Gen Z, and I love cold espresso. So, but it is definitely an increasing trend, and we don't see it going away. What we are encouraged about in the quarter is that our beverage grew 10%, and that was a combination of growth in both hot and cold. So we did see growth of about 2% weighted on that 10 from a hot perspective, but we also saw cold grow about 8%. So we continue to innovate in both areas so that we can, offer coffee and continue to lead in coffee for all of the different customer tastes and profiles, but definitely cold is a big opportunity for us, which is why you see us continuing to innovate in areas like ice shake and espresso and refreshment, and even with our new blended lemonade refreshers. Those are all areas for us to be able to continue that growth in cold, which not only grows in the morning, but actually has a position across all day parts. So we see a lot of opportunity ahead, but it's definitely not going away.
And one investment that got a lot of buzz this past quarter among consumers is those new ice nuggets that you guys are switching over to. How much money do you expect to save at the end of the day with this investment? And what's the response so far?
Well, what I'd say is we're in the early journey of what we call our nugget ice, and being able to put nugget ice in our stores. We've hit our highest volume cold stores so that we can actually support the capacity. And that's largely what the nugget ice is about. It's to be able to support the capacity of the cold demand. And so we'll continue to roll out across our stores. Early on, what we're seeing is it's better for partners. It's easier in terms of overall, it blends faster. Well, eventually it'll be piped into the stores, so they'll no longer have to be, carrying buckets of ice. And so it's a better option for the partners and creates a better experience. But at the same time, our customers love it. And so the combination of that, gives us confidence that we'll be able to continue to fuel the growth, cold growth that we see, with improvements and advancements like nugget ice.
And hitting on those employees on the back end really quick, you did see baristas leaving improved by 11%. You saw take-home pay jump 20% year over year. But Lax did hint on some further improvements for baristas, for employees, you guys making month over month. Any sort of insight you could provide there? And also, can you provide an update on where you stand right now with bargaining with those unionized stores?
Yeah, I'll start with the fact that from a bargaining standpoint, what I would just start with is, from a unionization standpoint, we continue to believe that a direct relationship with our partners is best from not only a culture, but the experiences that we value. But we support our partners' decisions when it comes to, determining if they want to be part of a union, and we'll continue to bargain in good faith. What we're focused on is how do we continue to leverage our reinvention to create the very best experience for all of our partners. And part of that comes from the investments we're making in our business, the investments we're making in things like nugget ice, as an example, but also the investments we're making to create a more stable environment. And more recently, what we talked about on the call was that we're trying to find the right amount of hours for our partners. That comes through advancements we're making in staffing and scheduling. And we're on a journey. We've made some progress, but we have, a journey ahead of us. But we're encouraged by the early signs that we're seeing because it's helping to reduce turnover and create a more stable environment. And that stable environment's better for partners. It creates a better experience, but it's better for customers. So we'll continue on that journey. And more specifically, what we've done is we've taken our staffing model in-house so that we continue to innovate on a more store-by-store basis. And that way, we're more targeted in the investments. I think the real opportunity for us as it comes to labor and the investments around labor is to be more targeted on a store-by-store basis. When you think about how important personalization is and customization is in our business for our customers, it's that same sort of concept for our partners. The more we can personalize the experience, and that comes through the hours they need, the benefits they need, that's where we have tremendous opportunity ahead, largely from an engagement standpoint, which we know is a key driver of the value of the Starbucks experience.
Rachel, I want to ask you about the China story and the penetration in China. So the average Chinese consumer only drinks about a dozen cups of coffee a year. I find that shocking. I mean, I drink that, and I won't say a week, but what are you all doing in terms of penetration there, especially when you need to, say, account for some slowing of sales growth in the U.S.?
Yeah. You know, for us, what that speaks to, that 12 cups of coffee, really speaks to the demand. I mean, this is one of the largest consumer markets in the world. And so we see the demand is increasing for coffee. And so what we're focused on, even though we're in the early journey of recovery, what we're focused on is how do we differentiate ourselves? And so we continue to focus on innovation, as well as increasing our omnichannel capability. That gives customers multiple different ways to interact with us. And we're also continuing to focus on opening new stores because that allows us to continue to bring in new customers and create new occasions. And all of that's underpinned by an experience that our partners create for our customers each and every day with every single visit. We think that that's the value of the Starbucks experience that's going to help not only in the near term, but support our long-term growth ambitions in the market.
Rachel, finally, back here in the U.S., we were very focused this morning on Fitch Ratings' downgrade of U.S. debt, which is, I realize, outside your purview, but I am curious. You know, one of the reasons that Fitch is pointing to here is the dissent that we are seeing in government, the effect that has on fiscal policy, et cetera. And I just wonder how you guys are thinking about that issue as a potential threat to economic growth going forward in the United States.
Well, it's incredibly important, which is why we've been focused on continuing to operate within a 3 times leverage ratio. So that's the guide that we keep so that we can maintain our B+ rating, but also it allows us to be able to support, I'd say, a more conservative stance in terms of our overall financial health. You know, we have a strong balance sheet. We're strong from a financial perspective. And so it's important for us to continue on the journey as we see, you know, interest rates continuing to increase and I'd say some instability in the overall macroeconomic environment. So our financial fundamentals are in place and I would say position us well to be able to grow in the future.
Amazon out with its second quarter earnings, shares rising after beating on the top and bottom line. The company also topped estimates for operating income and delivering optimistic guidance. Joining us now is Rohit Kulkarni, Roth MKM Managing Director. Rohit, we are seeing shares rising in after hours on the back of these results. So what's the big takeaway for you?
Clean beat and raise numbers. Fundamentals are better than expected. Amazon coming above their high end of the guidance and 3Q outlook being kind of the low end of 3Q outlook is above the street. So this is as emphatic a beat and as emphatic a raise that we have seen in from Amazon in probably 18 months. So, and the big other takeaway is AWS. The cloud growth has stabilized. That's what they have said in the letter. And that means we are seeing an inflection in cloud growth from Q2 to Q3. I believe the moment people start to digest an inflection, that's when the stock goes even higher.
Rohit, I want to ask you, when it comes to when you get on the earnings call, what are you looking to hear with regard to the path and trajectory for AWS growth?
I think what we would love to hear is 2 things. One is how is AI contribution towards AWS kind of trending? Microsoft gave somewhat of a glass half empty kind of situation there where AI contribution started to decline for them. If Amazon provides extra color about how AI and AWS are going hand in hand, I think that should help the stock and the sentiment. And second, I think they're already talking in the letter that AWS has stabilized. So how high can AWS growth go in the near term, given the year-on-year comps are easier in August and September? I think any extra color around that, I think those 2 data points on AWS would definitely help with the sentiment. The third point is Prime Day. Prime Day was the biggest Prime Day they have had in the history. Obviously, we see that in the numbers. We see that in the 3Q guide. But just generally how they see the state of the consumer, state of buying patterns of consumers, trend in the rest of Q3 is kind of assumptions around that would also help.
Rohit, there are a lot of concerns about the AWS growth going into these results, particularly on the back of what we heard from Microsoft as well as Alphabet. A lot of companies pulling back some of those investments. You know, I've heard you say many times now that growth, at least in the cloud, has stabilized, but it certainly feels like the outlook is a little more positive for Amazon in this space. What is AWS getting right?
In my opinion, AWS has been working on a complete full stack AI offering, which is they have their AWS AI chips, which is for your large language model training and inferencing. They have their own chips that they have probably, I would say, anywhere between 3 to 5 year lead versus Microsoft and Google. They have been working on that over the last 5 years. And on top of that, I think AWS probably has the best data offering across all cloud vendors. So think about the first thing that anyone wants to do with the AI in the cloud. You want to get all your data into the cloud. There is a gravity of data, and that data gravity helps AWS because they have probably the best database offerings, the best data warehouse offerings across all cloud vendors.
And Rohit, shares of Amazon are up more than 50% year to date. How high are you expecting this stock to go this year?
Again, Amazon is our number one mega cap pick, is what we have published for second half and probably heading into 24. In my opinion, I think we are at couple of inflection points at Amazon. The first inflection point is obviously AWS, which we see. The second one, which we are yet to see, is our margins in North America and international retail. I think that's still work in progress, but after having cleaned up their act around fulfillment, around logistics, around hiring, 6 quarters in a row, their employee headcount has declined. That not a single company has done that in the last 6 quarters in a row. So as we start to see, as we get to Q4, we should start to see retail margins ramp up, and that brings the stock higher even more from where we are right now. Obviously, our price target here is 155, but we see that grind higher given where the numbers will shake out after tonight.
Rohit, we have seen a big push from the company to increase third-party sellers, and we're seeing third-party seller services net sales coming through from there at $32.3 billion, about an 18% growth year on year. How much higher how big of a driver do you expect that to be when you think about the ad dollars coming in from there?
I think it's a fantastic virtuous cycle that Amazon has figured out between their fulfillment by Amazon, the Prime offering, and their third-party seller offering, as well as advertising. So once sellers are onboarded, you are on the fulfillment by Amazon offering, and then you are also in the advertising thing. So I feel they are taking away share from larger advertising companies, say like, for example, Google and Facebook, and plus they are taking away share from smaller e-commerce providers. So in my opinion, this is still something that, based on their kind of 3 pillars of e-commerce, which is advertising on Amazon, fulfillment by Amazon, and obviously the Prime, that creates a moat that probably we are not going to see that break anytime in the near future. Plus, again, they have a new CEO on Amazon.com, Doug Harrington. I think what he's been saying is that decentralized fulfillment centers has created the best and the fastest fulfillment network that has ever existed on planet Earth. So what that means is, the moment you start to get that speed of delivery, the speed of convenience, I think, yeah, it's hard for, we are on the cusp of the next kind of big unlocking of shareholder value for Amazon, and I think we have just started.
Rohit Kulkarni, Roth MKM Managing Director. Appreciate you hopping on today. Good to talk to you. We are watching shares of Apple trading. It's just a little lower, down about 0.5% here on the back of their earnings results. The company posting a third straight quarter of declines in terms of revenues. Earnings coming in at $1.26. Estimate was $1.21 a share. Revenue beating expectations, coming in at $81.8 billion. Versus the estimate of $81.56 billion. Let's try to break down some of the categories for the company. iPhone, certainly a big one that investors are watching. That revenue was a miss, coming in at $39.67 billion. The expectation was $39.79. Services beating here, their revenue at $21.21 billion versus the $20.7 billion that was expected. We are also seeing iPad revenue a miss. And then the wearable space, That was a beat there at $8.28 billion versus $8.38 billion that was expected. One of the markets we like to watch very closely, Greater China, that revenue coming in much stronger than expected at $15.7 billion there. Joining us now is Bob O'Donnell, Tech Analysis Research President and Chief Analyst, and Ray Wang, Constellation Research Principal Analyst Founder. Good to have both of you on. Bob, let's start with you because, you look at iPhone revenue being there a miss, but this is something that every smartphone company out there has had to struggle with in terms of declining demand. What do you make of the numbers coming out from Apple?
You know what? Actually, they're not bad. I mean, all things considered, there was a big expectation that the numbers would drop a fair bit this quarter because, as you pointed out, there's a huge drop in smartphone shipments across the Android ecosystem. Qualcomm had a bit of they did reasonably well. They made guidance, but it was still lower. And they power a lot of the Android ecosystem. Of course, they still supply modems to Apple as well. But, I think all things considered, as you pointed out there at the end of Kiko, the China numbers are better than people expected. And of course, once again, it's services that kicks in and really makes up the difference for Apple. And that's what I think a lot of people were hoping for. As long as those iPhone numbers were close, and clearly they were off, but not terribly, you knew the services could kick in and fill in the rest.
Ray, let me pick up on that point that Bob just made there in terms of, this not being as bad. Obviously, a lot riding on what's about to come for Apple with that September event and the iPhone 15. How do you look at the numbers today in the context of what is traditionally a weaker quarter for the company?
Bob's absolutely right. This is much better than expected. But the most important thing really is the active number of users, active devices that they have. This is all about how much money they can make per device. It's not about total iPhone sales. And what they were able to show is that services are continuing to grow and the non-iPhone sales around wearables is also picking up. Those two are complementary. And when you think about what the average spend per user is, that number has continually gone up over the last 24 quarters. And that's really because of their ability to actually expand iPhone and expand services growth. Those two things have actually made up to be the better part of the story. And by the time we get to a September event, right, those sales will then hit into the next cycle and to the next year. So that's actually a good news for a lot of investors. But more importantly, it's good to see that on the high end, we're still seeing growth. China has recovered. And of course, we've yet to see what happens with the India numbers. I'm not sure the breakouts were in there. So.
Yeah, I didn't see the breakout so far in there, Ray. I want to pose this question to you because, for instance, on their last earnings call, Tim talked about that a lot, about the opportunity in India. What are you looking to hear on the call when it comes to the India market?
Yeah, I'm hoping someone asks the question about, hey, have they seen gains in India now that they put 3 flagship retail store operations in there? There's plans to do manufacturing in India, and I think that's going to be a long-term winner for Apple over the next 3 to 4 quarters. That's something people are going to watch for those volumes. And then, of course, thinking about what else is coming out of India in terms of the services growth, that will be the attach rate to what's actually happening with the devices.
Bob, let's pick up on that point about India, because I feel like we've been talking about the potential of India for many, many years now.
Yes.
It does certainly feel like Apple has been planting their roots. They're starting to see some of that take shape. But how do you think investors should be looking at that market where it is right now in the context of China and some of the headwinds that a lot of companies like Apple are facing there?
Well, I mean, look, it is going to be incredibly important. I think there's going to be a couple of unique challenges to India. First of all, of course, we haven't seen as many premium phones in general sell there. It's much been more on the lower end. Now, Apple does have a bunch of lower cost, older versions of iPhone products. And to Ray's point, it's once you get an iPhone, then you get attached to services. Now, the other concern, though, with India is I think we're going to see some slower attached to services there because it's very much more of a hardware-focused market. Obviously, they use services, but I don't think to the degree that we've seen in some of the other markets. So I think India is going to be interesting. I think it will be different than China. I don't think we can think of it the same way. I think you'll see a little bit lower ASP in terms of the phones that are being purchased there. I think you'll see a little bit of lower attach, but it's still a huge opportunity. And they have almost no installed base in India. It's extraordinarily small. So the great thing is it's almost nothing but upside for them there.
And Bob, I want to ask you in terms of both the iPhone 15 and say the newest Apple Watch, is that enough to be supportive of Apple's continued strength?
Well, yeah, I mean, look, it's going to be, we're going to see upgrades. It's not going to be probably radical, more than likely, right? Until Apple does, say, a foldable along the lines of a Samsung or what have you, which I think eventually they'll do, maybe a foldable iPad first, but eventually I think we'll get there. You know, it tends to be incremental upgrades. I think you'll see that again this year, but it's enough. Remember now, we're not in that phase anymore of everybody upgrading every year. It's every couple of years. So most people are going to be upgrading from, say, an iPhone 12 or maybe a 13 or even maybe an 11, right? And so when you make the comparisons between the 11 or 12 versus the 15, they are big. And so that's the important thing to bear in mind in a very mature smartphone market, especially here in the US and a lot of parts of the world where people, you know, are big iPhone fans. That's how they think about it. So with that in mind, I think they'll do just fine. They'll have enough things there to keep it interesting, and that will continue to drive the market forward.
Yeah, Ray, we got those reports a few weeks ago about Apple potentially sort of keeping the shipments with the iPhone 15 pretty steady to where it was a year ago. 85 million units is what Bloomberg reported. Does Apple have to raise the price on especially the Pro level to keep this revenue and this cycle going when you consider, to Bob's point, sort of the broader length of an upgrade cycle? What are we talking about now? 4 years?
Bob's right. We've stretched out the replacement cycle, but we're in a super wave of replacements, right? There's something about 200 million units that could potentially replace. 85 million is a good number for what's going to happen on the high end, but of course there's stuff in between. And yes, most people are switching out phones every 2 to 3 years. The services plans are 2 to 3 years when you look at the big carriers in North America, and the same thing that's happening in other markets. So I think that's important. But along the way, right, we're seeing gross margin also go up, right? It's 0.3% versus what was estimated, but I think it's a very important piece. And so you're going to see not only just the additions of an iPhone 15, which actually helps with the launch, you're going to see additions in terms of updates to the Mac family and the iPad family. You saw there was a 20% year-over-year decrease on the iPad. There's going to be new products along the way that will fill in the gap. And, the surprise is the wearables. No one expected the wearables to continue to do this well. Remember when Apple said they were going to announce a watch, everybody was like, is that going to make a big difference? And it has. And you can see that as they've diversified, even though the iPhone is still about 50% of their revenue.
And Ray, I want to ask you, so services revenue was a beat, right? What does Apple need to be doing more to incorporate? What are you looking to hear when it comes to generative AI, considering they were a little late to the party in that respect?
Well, here's the interesting thing. On one hand, they're a little bit late to the party for marketing AI, but on the other hand, they've been incorporating AI in all their devices for quite some time. They've got AI in chips, which they've been talking about for years. They are able to suggest things, right? Siri's been around for quite some time. So they're not ahead on AI. They're not behind on AI, as people are saying. They're actually ahead on AI because they don't talk about AI saying, hey, here's the shiny object on AI. They say, here's the benefit of what AI can do for you. And I think that's the difference and the nuance you should be listening to, or we should be listening to on the earnings call, to be able to understand how far along the AI spectrum they are and where is it benefiting users and where it's benefiting them in terms of their network.
Yeah, Ray, I feel like you just tapped into your inner Tim Cook in the framing of that AI discussion. But Bob, the last time we talked about this, you highlighted this when the company unveiled its headsets, the Vision Pro. You said this is great, there could be mass adoption, but where is the AI play in all of this? How do we look at that? The Vision Pro, where the future is, obviously it's not a big revenue driver immediately, but if they don't have that key AI component, what does that look like?
Well, a couple of things. So on Vision Pro, look, they've already pulled back. Even initial estimates, some people were saying 1 million. Now it's down to 400,000. I mean, it's going to take a long time for that category. I think it still has a long way to go to really be the AR sort of product that people want. But I'll say a couple of things. So Apple as Ray said, Apple has been using AI, but they've been using sort of more traditional AI, machine learning, things like that. What they have been missing is the new generational AI, generative AI stuff. And that's missing. And yes, Siri's been there, but look, we all made jokes about Siri because it never really worked well. Mind you, nor did Alexa, nor did Google Assistant. And you're seeing both those companies, Google and Amazon, saying, we're going to put a foundation model underneath these assistants, and they're finally going to be able to do what we want them to do. I think you'll see the same thing happen with Siri. But Apple, again, is going to take the Apple approach. They're going to frame it just very nicely. Like you said, I think Ray did a good job of providing the perspective that Tim will probably say. But when they're ready, they will launch with full force about generational AI-based stuff. And I think you'll see it in Siri. You'll see it in other places. Right now, they'll probably talk about filtering on the camera and other things that we've seen other companies talk about. But eventually, you're going to see some of those services. And I think Apple will find clever ways to integrate it. They're always going to be there. They're going to wait till they feel like they've got a unique angle to it, and then they'll pounce. And I think we'll see that sometime in 24.
Bob O'Donnell, Ray Wang, great to get both of your perspectives on the back of these numbers. Appreciate the time.
Disney out with a beat on earnings and a narrower than expected streaming loss, but revenue missed expectations and streaming subscriber numbers fell short. That's pressuring the stock in after hours trading. We're looking at a loss of just about 1%. For a deeper dive, we want to bring in Geetha Ranganathan, Bloomberg Intelligence senior media analyst. Geetha, it's good to see you here. So some good news and bad news in this report, at least from the looks of it right now. Some concerns about subscriber numbers missing expectations, revenue coming up a bit short. That's dominating the trading action here in after hours. But what's your first take at these results?
Yeah, so my very first take was, of course, at that streaming loss number, which actually came in much better than expected. We were expecting about $750 to $770 million in streaming losses. They came in substantially lower at about 550 million. That's one thing. Of course, as you pointed out, the streaming subscriber miss, at first glance, yes, it does seem like a huge miss. But then if you just dig a little bit deeper, most of those subscriber misses, actually 12.5 million subscriber losses, were at the Indian division of Hotstar. And remember, this is because, Disney actually has foregone a key piece of content, which is the Indian Premier League cricketing rights. Those rights, Disney kind of gave up on, just in a focus on being, kind of more cost conscious and cost disciplined. So we kind of expected this, and it's not really a big, it's not a big contributor to revenue, because if you look at a Hotstar subscriber, they bring in roughly about 50 to 60 cents per month versus a Disney Plus subscriber here in the US who brings in over $7. So it's not, the subscriber miss, the optics of it looks bad, but it doesn't necessarily really affect the profitability or the revenue line all that much.
Geeta, this is a company that is clearly very much in transition when you think about what it's trying to do with some of its more legacy parts of the business versus investing in streaming and other parts of the business where they see the future. Looking at where the company came in, they reported a $2.6 billion one-time charge in impairments. That was part of the number that dragged things down. Where do you think the company is in this transition, in this restructuring? What do these numbers tell you?
That's a great question. So I think that is really about trading some short-term pain for longer-term gains. So the narrative, at least in the streaming world right now, has shifted away from subscriber growth or just chasing subscribers for the sake of chasing them to more on profitability and being able to get to good end unit economics, making sure that the streaming business is a consistent long-term earnings growth driver. And I think Disney is doing exactly that. So that one-time charge, yes, it did depress earnings in this quarter, but what it does is it sets up the company for a much leaner and a cleaner kind of content cost profile. So remember, Disney is one of the largest spenders of content in the media landscape. They spend about $31 billion. A lot of that, of course, is sports rights, which is paid out by ESPN. But then you have a lot of entertainment content as well, whether it's films, whether it's a new Marvel series or Pixar animation films. So all of this, and Disney is really kind of trying to right size the cost base to make sure that they can ensure hitting those profitability targets sooner than expected. So they had actually guided to getting to profitability in the streaming business by the end of fiscal 2024. We'll have to wait and watch and see if management says that they can accelerate that timeline, get there a little bit sooner. That should be something that investors can cheer about.
Geeta, what do you think about Iger's vision, his broader vision for ESPN? We had the news yesterday about Disney teaming up with Penn Entertainment, going into sports betting, something that many analysts had expected now for quite some time. But does this signal anything broader just about what the future could look like for ESPN?
I think the one thing that it definitely does tell us is that there is still a lot of value in the ESPN brand name. I think that is, a question that some of the investors were kind of asking, is there really value in ESPN? Does it have, the name recognition, the brand recognition? And absolutely, yes, it does. The fact that they're now able to get, $2 billion over 10 years without necessarily getting directly involved in the sports betting business, obviously, I think is low risk, high reward for, Bob Iger. So kudos to him for getting that deal done. And it really helps them now kind of monetize younger audiences, right? It's not just about reach, it's about kind of being able to monetize that. And they're going to be able to do that now. Does it say anything about whether they're going to spin out or sell the company? I'm not sure as yet. ESPN is still a very critical brand. It's still a very, very critical property to Disney. Of course, all options are on the table, as Bob Iger has said repeatedly. But having said that, you have to remember, ESPN is also important to the company from a bottom line perspective. Yes, it is under pressure because of cord cutting, but it does still bring in about $3.5 to $4 billion in EBITDA every year. And now you have this additional revenue, of course, from the Penn deal as well.
Finally, we've been talking a lot about what that content pipeline looks like for so many studios, given just how long the WGA strike has been going on, and now you've got SAG-AFTRA on top of that as well. Bob Iger has said, at least publicly, he doesn't think these demands are realistic. How how big of an impact is this having on the company? I mean, how do we kind of bottom line it? Because we keep hearing the pipeline is still there. It's a matter of how long this goes on. What do you see?
That's a perfect point. And ironically what we're seeing is the strikes are actually helping the bottom lines of these companies. I mean, we've seen this across the board from a Paramount to Warner Brothers Discovery, and today we saw lower streaming losses for Disney as well. So it's fewer content costs, so obviously better profit profile, something that the street is extremely focused on. So in the short term, it's actually helping them, ironically, but in the long term, that's when it's going to become a real problem, because content is the lifeblood of all of these media companies, most notably Disney. They have all of their key franchises, which are critical to driving new subscriber gains, which are critical to driving revenue and ultimately profits. So the sooner these strikes get resolved, obviously it is better for the industry as a whole.
Geeta Ranganathan, Bloomberg Intelligence Senior Media Analyst. Good to talk to you today. Appreciate you stopping by.